Welcome to the basic market structure module. In this first part of a series, I'm going to be starting out with the simple foundations of market structure. It's important we have the basics nailed before moving on to more complex theory. The goal here is to recognize the intentions of price action and to be on the right side of the market more often. Starting out, like I said, very simply here. An uptrend is defined as a series of higher highs and higher lows. A downtrend is defined as a series of lower lows and lower highs. Most traders know this, but unfortunately this is where their knowledge on the subject ends. By the end of this first module, you'll already have an advantage over most of the market. As a side note, the market is only ever in one of two states, trending or consolidation. In this module, we will only cover trending environments. So let's talk about breaks of structure. In this bullish example, to the left, we define the break of structure as a closing candle above the previous high. Once the close occurs, we would then mark out the higher low. This is a mechanical rule that must be followed. The higher low is not confirmed until the break of structure has occurred. We find the higher low by marking the lowest point between the previous high and the break of structure. If this is the other way around, we mark the higher low as the highest point between the previous low and the break of structure, as you will see to the right. Now let's discuss the concept of strong highs and lows versus weak highs and lows. The concept works like so. In an uptrend, the expectation is that highs will be taken out and lows will hold in order for the trend to continue. Therefore, we can derive that the lows are strong and the highs are weak in an uptrend. Inversely, we have a downtrend where the lows are weak and the highs are strong. The lows are weak because they're expected to be taken out, and the highs are strong because they're expected to hold in order for the trend to continue. You can begin to see how we might form trading plans using this concept by simply trading near strong structure and targeting the weak structure. We'll come back to that. But for now, let's move on. In a trending environment, we can essentially dilute price action down to two phases: runs and pullbacks. A run can be defined as a single move from the origin of the break of structure, and the pullback can be defined as a significant retrace from the resulting move. We'll cover that in more detail soon. Of course, trends don't last forever. Here is a famous market top that clearly signals the end of an extended trend using simple market structure. In this example, we see higher highs and higher lows until eventually a shift occurs. A new lower low is formed below a previous strong low. We'll cover this in more detail in a particular future module. For now, we'll continue with learning about trading with the trend. Here in this example of a bearish trend, you will see a clear downtrend. It's important to begin training your eyes to see the underlying structure of price when observing candle charts. After a break of structure, the expectation is that there will be a pullback to fuel the next move, and structure will hold if the trend is to continue. It's worth noting that just because you have seen a break of structure doesn't mean that there needs to be an immediate pullback. Often the market can follow through with momentum, and the pullback may not begin for hours, days, or weeks, depending on your time frame. So how do you know when the pullback has begun? Well, I personally use something known as internal breakup structure. It follows the same rules as breakup structure, but with important distinctions. It must also be said that whether a pullback has occurred or not is subjective, but I personally prefer this method as it keeps my rules consistent and mechanical. Zooming in on our previous live example, we can see the point in which the internal breakup structure occurs and the pullback commences. Whilst we're still training your eye to see these structures using candle charts, I've included the accompanying line chart which clearly illustrates the IBOS, or internal breakup structure. An IBOS is similar to a breakup structure in that a candle close is required, but with a key difference. This brings us on to mapping swing and internal structure. In this bearish example, the swing range refers to the strong high that led to the breakup structure, and the weak low in which the pullback commenced. In this instance, we would refer to the swing trend as bearish because there was a bearish breakup structure and we expect the lows to be taken if the trend is to continue. In this bullish example, the swing range refers to the strong low that led to the breakup structure and the weak high that was broken as the continuation of the trend. The internal structure simply refers to the price action that occurs between the swing high and swing low, also known as the swing range. In this example, when the first IBOS occurs, we would consider the internal trend bearish within a bullish swing trend. When the second IBOS occurs, the internal trends shift. So now we have what's called alignment. Internal breaks of structures don't just help inform us when a pullback may be starting, but also when it may be finishing. Of course, this isn't always the case, and we may often see fake signals. So how can we use mechanical rules to help us increase the probability of these signals? We use premium and discount, simply defined as above or below the 50% retracement, depending on the swing trend. When the swing trend is bullish and an IBOS occurs below the 0.5 or in the discount zone, this would be considered a higher risk to reward opportunity, and so the expectation is that it would attract potentially more buyers, also known as demand. Inversely, if the swing trend is bearish and there is an internal breakup structure above the 0.5 or the premium, then this too would be considered a higher risk to reward opportunity and potentially more sellers or supply would be interested. More on supply and demand in future modules. So using what we've learned so far, we can begin to form a simple trading plan for trading with the swing trend by following a simple set of mechanical rules. When the swing trend is bullish, trade only an internal breakup structure that has occurred below the 0.5 for a higher risk to reward opportunity. As you can see from this diagram, we wait for the IBOS inside the discount. We have an invalidation below the strong low, because as we know, if the trend is to continue, the strong low will hold and the weak high will be taken. Therefore, we have an entry point, we have an invalidation, and we have a final target. When the swing trend is bearish, trade only an internal breakup structure that has occurred above the 0.5 for a higher risk to reward opportunity. Trade from strong structure and target weak structure. Trade the trend until the end. And that's it. That completes our first module of the Advanced Market Structure series. I hope you've learned something and I hope you've enjoyed. This is only the beginning. Next up, we're going to be diving deeper into supply and demand, discover how markets move and uncover the footprints of the largest players. Then, multi-time frame analysis. We build more context and accuracy increase our risk to reward dramatically, and learn to trade against the trend. Followed by advanced supply and demand. You'll never look at the markets the same. Followed by building a trading plan and execution. Thank you for watching.